In the year 2000, a man named Masayoshi Son, one of the richest humans alive, lost $70 billion. Not in a war, not in a scam, in the stock market, in less than 12 months. And here's the part nobody talks about. He wasn't alone. $6.2 trillion vanished from the global economy between 2000 and 2002. That's more money than the entire GDP of Japan. Gone. Evaporated. Like it never existed. So how do you lose $6 trillion? The same way you always do. You believe the story before you check the math. Let's go back to 1995. The internet is new. Most people don't even have email. And a 26-year-old named Jeff Bezos is selling books out of his garage in Seattle. Then something happens. A company called Netscape, a web browser nobody had heard of, goes public. On day one, its stock doubles. By the end of trading, it's worth $2.9 billion. They had zero profit, barely any revenue. But Wall Street didn't care because the story was irresistible. The internet was going to change everything, and whoever got in first would own the future, so the money poured in. Venture capitalists wrote checks for companies with no business plan. Teenagers became millionaires overnight. CEOs in Silicon Valley were on magazine covers like rock stars. Pets.com raised $82 million. Their business plan? Sell pet food online with free shipping at a loss on every single order. Nobody asked the obvious question, because the music was too loud and everyone was dancing. By early 2000, the NASDAQ, America's tech stock index, had climbed 400% in 5 years. A single index, 400%. And then on March 10th, 2000, it peaked. No explosion, no announcement, no villain pulling a lever, just a number on a screen that stopped going up. A few smart investors started quietly selling, then more, then institutions, then the panic set in. The problem was structural and brutal. Most of these companies were burning through cash at terrifying speed. They called it the burn rate. And when the venture capital stopped flowing, they had nothing left to burn. Webvan, a grocery delivery startup, had raised $375 million and was valued at $1.2 billion. They built warehouses across America, hired thousands of workers. In July 2001, they filed for bankruptcy. 1,000 employees lost their jobs in a single day. Here's what a $6.2 trillion crash actually looks like. Amazon, yes, that Amazon, lost 90% of its stock value, from $107 per share to $7. Cisco, one of the most valuable companies in history at that point, lost 86% of its market cap, $400 billion. Gone. Qualcomm had risen 2,609% in 1999 alone. Then it fell 70% in the crash. Thousands of dot-com companies didn't just lose value, they ceased to exist. eToys, Cosmo, Boo.com, Flues, the list goes on for pages. Boo.com spent $188 million in 6 months trying to build a fashion website. They launched late, it barely worked, they burned through everything and shut down in 2000. Here's what makes this truly dark. It wasn't just the investors who lost, it was the employees. The ones who stock options instead of salary because they were told they'd be millionaires. Overnight, those options were worthless. And back in California, Masayoshi Son, who had invested in nearly 300 dot-com companies, was watching his net worth fall by $600 million per day. Per day. By October 2002, the NASDAQ had crashed 78% from its peak. 78%. To put that in perspective, to break even from a 78% loss, you need a 354% gain. The reckoning was savage. But here's what made it worse. Many people inside these companies knew. Internal emails at major banks showed analysts privately calling stocks garbage and a dog, while publicly recommending them to retail investors. Merrill Lynch paid $100 million in fines. Henry Blodgett, their star internet analyst, was banned from the securities industry for life. The people who got hurt the most weren't the venture capitalists. They had diversified portfolios. They could absorb losses. It was the 401k holders, the teachers, the nurses, the regular people who had put their retirement savings into tech stocks because their broker told them the future was being built right now. They were right about the future. They were just early by about a decade. Here's the thing that keeps historians up at night about the dot-com crash. The vision wasn't wrong. Everything these companies promised eventually came true. Online shopping, streaming, cloud computing, digital payments, it all happened. The companies that survived, Amazon, Google, PayPal, became the most valuable in human history. The crime wasn't the technology, the crime was the timeline. Investors weren't wrong about where the world was going. They were catastrophically wrong about when. They priced in 20 years of growth in 18 months. And that gap between the story and the reality cost $6.2 trillion. There's a name for this pattern in behavioral economics. It's called narrative bias. The tendency to buy a compelling story before verifying the fundamentals underneath it. It happened with tulips in 1637. It happened with dot-coms in 2000. It happened with crypto in 2021. And if history is any guide, it's happening somewhere right now. Remember Masayoshi Son, the man who lost $70 billion. He didn't quit. He didn't disappear. In 2000, he and in a small Chinese e-commerce startup that nobody believed in. That startup was Alibaba. His $20 million bet eventually became worth $60 billion. The man who lost more money than almost anyone in history turned out to be one of the greatest investors of his generation. So the question isn't whether crashes will happen. They always do. The question is, when everyone else is running for the exit, do you have the nerve to walk toward the door? If you want to understand how the next crash gets set up before it happens, subscribe, because the signs are always there. Most people just don't know how to read them.